Opendoor stock ended Monday's session lower, down 30 cents, or about 3.96%, to close at $7.27 per share. It was a frustrating session for investors because the stock spent most of the day hovering near even territory before late selling pressure pushed it into the red during the final hour. There wasn't any specific bad news, just the kind of slow fade that happens when the market mood weakens and buyers hesitate to step in. But beneath that surface, nothing fundamental has changed about Opendoor's story. In fact, this kind of late-day flush can sometimes be exactly what clears the way for the next move higher. The session started quietly. Opendoor opened near Friday's close and traded sideways for much of the morning. Midday volume was light, which is typical for consolidation periods. Then, in the final hour, a combination of low liquidity and broader market softness triggered a wave of small sell orders that stacked together into a bigger slide. That's what pushed the stock from roughly $7.50 to around $7.27 into the close. This wasn't panic selling, it was more like exhaustion. The market simply ran out of buyers for the day. And because volume remains lower than average, these small imbalances in sentiment can create exaggerated moves. When you step back and look at the weekly chart, the stock is still sitting inside its established range, essentially between $7 and $9, a zone it's respected since mid-September. That's what makes tonight's message important. Price has drifted lower, but the structure hasn't broken. There's been no negative announcement from Opendoor, no guidance change, no insider controversy, no product misstep. The most recent company update was actually neutral to positive, the court giving preliminary approval to the derivative action settlement, which effectively clears one of the last legal overhangs from the company's past SPAC era. That's not exciting news, but it's cleaning work, the kind of corporate housekeeping that creates stability for long-term investors. Meanwhile, the company has confirmed its third-quarter earnings release date for November 6th, and leadership under Kaz Nejatian and Keith Rabois continues to push the same disciplined, AI-first operating message. So Monday's decline wasn't about fundamentals. It was about market fatigue. The pullback we saw wasn't unique to Opendoor. The entire growth sector softened Monday afternoon as traders responded to renewed uncertainty around interest rates and lingering caution about the global economy. But even that story has nuance. Long-term yields, the same ones that have been pressuring housing affordability, have actually been ticking down over the past few days. That's a sign that inflation expectations may be cooling. When yields fall, that's good for rate-sensitive names like Opendoor. But investors often take time to reprice that improvement into these stocks. The emotional lag can create a short-term mismatch. Yields ease first, sentiment follows later. We're in that gap right now. And this is why you'll often see these soft Mondays followed by midweek recoveries as traders digest the bigger picture. Let's pivot to what's working beneath the surface, because that's where the bullish story remains intact. Kaz Nejatian's leadership approach has been consistent. Build smarter, run leaner, and make every dollar of spend accountable. The AI procurement initiative he described last week, consolidating from 10 redundant SaaS vendors to just 1+ internal tools, is already estimated to save millions annually. That might sound like an operational footnote, but in a market where margins matter, those savings directly support the path towards sustainable profitability. Keith Rabois, now fully embedded as chairman, continues to push the company toward ruthless efficiency. He's made comments suggesting that Opendoor's future success will depend not on how many people it employs, but on how effectively it scales its software. That's the future of real estate tech, a lean, AI-driven operation rather than a bloated, human-heavy model. And Opendoor is ahead of that curve. Even amid share price volatility, the company continues to attract new investor attention. Figures like Mike Alfred have openly said they're watching the stock closely, citing the leadership credibility of both Rabois and Nejatian. When experienced fintech investors like Alfred express interest, it's usually not about timing a trade, it's about seeing structural potential. The company's recent settlement approval is a quiet but meaningful development. It essentially resolves legacy governance concerns from the SPAC era and implements formal oversight improvements. For long-term investors, that matters. It closes a chapter of uncertainty that many institutions use as a reason to stay on the sidelines. The fact that these reforms were voluntarily adopted also signals confidence. Opendoor's leadership is preparing for a more mature, stable phase of growth. Add to that the previous settlement earlier this year around the pricing algorithm lawsuit, and you start to see the pattern. The company is methodically clearing every distraction that could cloud the growth narrative heading into 2026. That's how foundations are built, quietly, deliberately, and sometimes while the share price looks stuck. When a stock drifts lower without a clear reason, it often triggers anxiety among retail holders. But if you study market structure, this is a classic shakeout. It's what happens in the late stages of a base. The impatient money exits just before the next leg begins. This pattern is amplified when volume is light, as it was Monday. In technical terms, the lower close doesn't confirm a breakdown unless we see follow-through tomorrow below $7. If that doesn't happen, if the stock stabilizes or bounces intraday, it will signal accumulation by quiet buyers. That's why you want to watch for higher morning volume on green candles. It's a simple but reliable tell that sentiment is shifting. Looking forward, there are 3 key events that could reset sentiment and bring momentum back: the Federal Reserve's next rate decision, the September housing data, and Opendoor's third quarter earnings on November 6th. That's the main event, and it's the first full quarter under Nejatian's operational leadership. Investors will be watching for progress on adjusted EBITDA, unit margins, and AI-driven cost savings. If the numbers even modestly improve, it confirms what many of us have been saying for months, that the turnaround is working beneath the noise. A red Monday after a soft close doesn't mean the story is over. It means sentiment reset again. That often precedes a short-term reversal if the fundamentals remain intact, and they do. Watch for 3 signals in the next session: early bounce attempts toward the 750 range, intraday volume spikes above Friday's level, and strength in peer stocks like Redfin or Zillow. If they move up, it's often a leading indicator for Opendoor. If those align, we could easily see a rebound into midweek, especially with broader market futures already hinting at stabilization. This is a patience game. Every recovery cycle plays out this way: grind, doubt, then breakout. Kaz Nejatian's post from the weekend quoting Jeremiah, "Build houses," now feels even more fitting. Because the core message applies perfectly to what's happening now. When the world is uncertain, keep building. When markets overreact, keep building. When the headlines go quiet, that's when conviction is forged. Opendoor is doing exactly that. While traders chase volatility, the company is focusing on transformation. AI integration, crypto payment exploration, workforce discipline, and process simplification, all while preparing for its next major earnings milestone. That's not a company in trouble. That's a company under construction. Monday's decline hurts in the short term, but context matters. The stock remains in its broader range. The fundamentals continue to improve. And the catalysts, both macro and company-specific, are still ahead, not behind. The next few sessions will be a test of conviction. Will traders see this as the end of momentum, or as a clean slate before earnings? If history is any guide, the latter tends to win out. Every meaningful move begins when nobody's watching, when the energy is lowest and the pessimism is highest. That's what makes these quiet red days matter. They create the base for what comes next. So stay patient, stay analytical, and remember that in markets, as in life, builders keep building. Because when sentiment flips, and it always does, it's those who held through the noise that end up one step ahead.